This is Barry Knapp with Ironsides Macroeconomics. It's 7:10 a.m. on Monday morning, June 30th, the last day of the quarter and first half of the year. Our note this week was titled Not So Solid. We didn't intend to write a first half review or second half preview, but after finishing the bulk of the note, we wrote the first section last and winded up doing something of a review of the first half with an eye towards how the second half would likely unfold. The structure of the note was as follows. We began with that section I just referenced, titled it The Relentless Rally. We then went on to a broader discussion of the economic outlook, the progression of the detox process we began discussing last week. And that section was titled Not So Solid, which is what we titled the entire note. We then got on to a broader discussion of whether the markets could look through this soft patch in growth because of policy, and called that patience or obstinance. And that was with reference to the Fed. We then had a very key section of the note where, in a discussion last week, we got to talking about the differences between the Tax Cuts and Jobs Act impact on the markets and the economy in 2018 relative to OBBBA, One Big Beautiful Bill Act. And this is a sort of a key section to our note this week and our outlook. We then had a discussion of currency policies, mercantilist currency policies, we'd call them, and some interesting actions since Liberation Day, the rally in most of our major trading partners' currencies, decline in the very overvalued dollar, and then wrapped it up with some market thoughts. So just to review for everyone our performance and how things have progressed so far this year. In December, we wrote, targeting a trifecta. We expected a 10% return for the S&P 500 this year, even better than that for the equal weighted S&P. We don't have the equal weighted really outperforming as of now, but we are on track for a pretty decent year for U.S. equities, unlike a lot of our successors in the equity strategy gig that we gave up back in 2014 when we did that job for Barclays for 6 years. We never pulled our price target. We got bearish in February. On February 22nd, we wrote Cleaning Up the Industrial Policy Mess, called for a correction, went on CNBC in New York, made that call. We got the correction. We held off and pretty much got the lows with our note, The Trump Trade Shock, on April 5th, where we decided that even if we did get a recession, it was more than fully priced, and recommended coming back into the markets. We've been overweight capital spending beneficiaries through the first half of the year, and underweight consumer companies, underweight healthcare because of the MAHA disruption that's coming, and underweight the back end of the treasury market. We are in the midst of this detox. And the question is whether we'll have a correction. So in our note this week is our start to look ahead, and we were discussing this last week. Although it's ancient news, we got the second revision of first quarter GDP. And one of the things that the Fed has been saying continuously is that private domestic final purchases, that takes out inventory and trade, was really solid. Well, it started out solid with the advanced estimate of GDP at 3%. But after two revisions, it's down to 1.9. So the economy wasn't so solid in the first quarter of the year, and it looks decidedly weaker in the second quarter. Service spending in particular has come down a lot. We think that's due to trade disruption and weaker government or lower government spending. So no, the economy is not so solid. And we saw that in earnings reports last week from FedEx, General Mills, Winnebago, and Paychex. Leave Nike aside, it's a special situation, but those companies are pretty good manifestations of what's going on. We have the employment report coming this week. We talked about the Conference Board labor differential, which points to a potential uptick in the unemployment rate to 4.5% this week, which would be a shocker and probably would sway a lot of people towards Waller and Bowman's call to get the rate cuts restarted as early as July. Now, the Fed is being obstinate around all this. We think they're wrong, but we'll see on payrolls this week. We will get out a payroll preview note. That's for our full subscribers, of course, so we'd love you to consider becoming one. We'll talk about that in this week's note, which we hope to get out Friday morning, not Saturday morning. And then we'll get the inflation report shortly thereafter. Those will be the keys to whether we get that early start and we get the policy pivot that allows the market to look through what's likely to be a weak earnings season for core earnings and soft patching growth for the next couple of months or so. Final point I'm going to make before I leave you with all this, which is there is a key difference between the Tax Cuts and Jobs Act and One Big Beautiful Bill Act. Tax Cuts and Jobs Act caused a level shift in earnings. And if you're looking at an email associated with this, you can see the chart that caused a 10% increase in earnings for mainly domestically oriented companies. It didn't help the tech sector. It didn't help the healthcare pharmaceutical sector. Because of profit shifting, they were already at a 20% effective tax rate. But for domestically oriented companies, it caused a big level shift. The second order effect was going to be a big increase in capital spending, but that was slowed by the first trade war. This go around, the policy sequencing is different. We've already had the trade shock. And if the Senate version of the bill is passed and those corporate tax incentives are made permanent, this is where we can get a real sustainable capital spending boom. It's why we're overweight industrials, materials, financials, and energy, and still have very healthy weightings to tech, and why we're underweight consumer-facing companies. So that's it for me this week. Please consider becoming a full-time subscriber. There's going to be lots of stuff coming out this week. If you're a full-time subscriber, you'll get access to real-time updates from us, as well as this payroll preview, and then, of course, the full notes. Have a good holiday, everyone. Bearing out from Ironsides. Thank you.